This is episode 121 of the Andrew Hines Real Estate Investing Podcast. Welcome to episode 121 of the Andrew Hines Real Estate Investing Podcast. Today I have Omar Khan on the show to talk about how he balances investing in real estate and investing in options. So Omar is an entrepreneur and a very down-to-earth guy, and he talks about how he looks to put his money to work where it makes the most sense. So guys like me, I've been such a real estate purist. I only have invested in real estate because that's what I believe in the most, but I do like to keep an open mind, and I'm trying not to be one-dimensional. So I thought it was a really good time to have a conversation with Omar and learn a little bit more about how he balances the two. So he explains how he got heavy into real estate after 2008. More recently, as he's looking at the numbers in Ontario, as we've all sort of started to notice, is they're making a lot less sense. So right now he's in a wait and see pattern, and he's focusing on his options, waiting for the right moment to strike and get back into real estate investing. So as you know, I've been looking out of the market. I've been looking in other areas to put my money to work because Ontario doesn't feel like the highest and best use for my money. There are still opportunities to be had. It's really just a matter of where are the most opportunities. So I thought this was an interesting discussion. I think you're going to enjoy it. If you're brand new to real estate investing, I highly recommend you go right back to the first episode of this podcast. We really get into the nuts and bolts, and I believe that it'll be very helpful for you in understanding the terminology and the basic concepts. If you have not already done so, please take a moment and quickly hit the like, subscribe, and notification bell, and leave me a comment. Let me know what you think. If you're an audio listener, please rate and review the podcast on Apple Podcasts. It'll greatly help more people to find it. Without further ado, please enjoy episode 121 with Omar Khan. Hello and welcome to the Andrew Hines Real Estate Investing Podcast. Today I have the long overdue episode with Omar Khan. He is on the show here today. We're going to talk real estate, we're going to talk trading, and everything in between. So Omar, without further ado, because many of these listeners and viewers are not going to be familiar with you, tell us a little bit about yourself.
Yeah, thanks, Andrew. First of all, thank you for having me on. I appreciate the opportunity to talk about what I do. So a little about my background. I grew up in an immigrant household, typical story, financially illiterate, and that's not limited to immigrant households. So as I grew older, went to high school, went to university, I went to one of the best schools in Canada, one of the best programs, came out financially illiterate. And I did an economics degree. So that should not happen, in my opinion. One should be prepared for, the world as opposed to theoretical nonsense, which is mainly taught in school, in my opinion. I'm not going to bash schools. I'm just saying the information that one learns is not always relevant. So myself and Matthew, my business partner, my best friend, we took it upon ourselves to get out of our hole, right? We had student debts. We had parents that we had to, one day support. We took it upon ourselves to make sure that we didn't want to live this life. So we started learning about trading. We started learning how to invest, how to trade. And we started making some pretty good money, got out of our OSAP debt, started accumulating some capital. And then 2008, 2009 hit, and that was the great financial collapse. Stock market went down by 50%. Now, I've invested for a long time, and I started investing in 1998. I knew that was a temporary event, and I was just going to hold it through, and I was fine. But what it made me realize is I don't ever want to have one asset category again. I started buying real estate at the end of 2009. My first property was bought at the end of 2009, and I accumulated 30 plus properties. I sold a few of them off, but I still have a sizable real estate portfolio. But what I've realized is when you combine the stock market and the real estate market, it becomes a beautiful thing. And that's what I do to this day. And 08, 09 made me realize that I need to buy real estate. The problem, I think, with real estate investors is they don't realize the other side of that equation. They're pretty much oblivious, and they're kind of blind towards the stock market, which, we started this company a year and a half ago. And the reason we did it is because we had done tremendously well for ourselves over the years trading. And we had actually taught about 100 or so friends and family for free just because we enjoyed it. We taught them how to trade, and people were like, hey, why don't you guys do this as a business? We never even thought about it. So we started about, I think, September of 2019, a little bit more than a year and a half ago. And here we are, 1,100 members later and growing every day. So yeah, that's my story.
Okay, yeah. So started with trading, then you got into real estate, and now you use them both. You're balanced into both.
Correct.
And I think balance is really important. And this is one of those things I want to push on today is what kind of balance, knowing the economic conditions today, how do we take advantage of the situation? So we'll dig into a little bit more of the technical in a second, but just looking at the market right now, do you have any feelings about our Ontario real estate market, and is that affecting some of your moves right now?
Yeah, absolutely is. I think the Ontario market, can rates go any lower? I suppose they could. What is going to propel this thing forward the next few years? I look at like where I invest in Hamilton. I look at cap rates on multiplexes. I look at just purchasing price on single families, duplexes. To me, they're not even reasonable because when I started buying, the cash flow was there. It was pretty decent. Now the cash flow is non-existent. Even at 30%, 35%, the banker is giving you, more and more of a requirement. You can still make money in real estate. BRRRR, adding value, being able to extract capital out and trying to get out of a deal with maybe little or none of your own money, and that's a great way to do it. But that's an active investment that requires a lot of work. But the landscape, in my opinion, is frothy in the real estate market, quite frothy, right? And people have short memories. They think, oh, you can't lose in real estate. Well, from 1987 to 1999, the real estate market in Southern Ontario was flat, didn't do a thing. It dipped and it came right back up, didn't do a thing. Mm-hmm. And I think there's a decent chance we could be headed into a similar environment for a prolonged period of time because rates can't go a whole lot lower. They're probably going to go up in 2023 and 2024. And I find that, when you have an intimate understanding of two asset categories, you're able to understand where to allocate your capital to the most effective source possible. The problem with most people is they only understand one asset category. When you only understand one asset category as an investor, what can you do? Well, you can only put money towards that one asset category because you don't know anything else. Now, if that one asset category happens to get extended or maybe overpriced, you're going to convince yourself that it's still a good investment. No, I should keep throwing my money into this. And whereas it might not be because you're not looking at it objectively. And what I'm saying is, it is very important to have another asset category, which you understand, like the stock market. Most real estate investors have little to no knowledge of the stock market. And that's to huge detriment to themselves because there is plenty of money to be made from the stock market, as you know. Yep. But it has to be done through the right way, just the right way when you buy real estate. You're looking at buying real estate. Like if I were to look at Southern Ontario real estate, Hamilton in particular, I see cap rates of like 3.5% on multiplexes in Hamilton. Now, to me, is that a great deal? Considering I think rates are going to go up in a couple of years, how much more upward, pressure can I put on rents? That's the only thing, two variables I can really move. I can raise the rent, increasing my NOI, right? Or I can have cap rate compression. I can have either one or both, and that'll increase my my price of my property. But I can't see. Rates are probably not going to go a whole lot lower, and rents might go higher with inflation coming, but
yeah, that's the key question. Like, how much can they go higher, right? And I agree with you completely. We're getting at a point in Hamilton where it's just out of the affordability range of the tenants. Yeah, so what are they going to do? They either start packing 5 people into a 2-bedroom, condo, and you might get that. And as a landlord, who wants that? That's going to destroy your place. So yes, the rents can keep going up, but it's going to become a very unpleasant place to be. And this is why, for me, like Ontario just hasn't made sense in a few years because of the compression in cap rates. I was spoiled in London earlier on. I was getting great cash flow. Yeah. And then the prices went nuts. And sure, I can say I like that my assets have gone up in value huge, but now when I'm making new decisions to get in, it just doesn't make sense anymore. So I, like so many investors right now, have been trying to figure out where do I put my cash? Like, what do I do? What's going to generate me cash flow and create freedom in my life? Because buying overpriced real estate isn't going to do that. And that's actually going to put me at risk and potentially make me a slave to that real estate if it goes underwater. Now I owe money and I don't have an asset to back it up.
Yeah, so I couldn't agree more.
So I've been looking outside markets. I've been looking in Florida, been there for the last 3 months. I'm actually just got home last night, but I see opportunity for cash flow there. It's still doing the same thing we're doing here, but I like the idea of having different asset classes. I like the idea of having stocks. I haven't gotten into this for the record yet, although I know yourself and so many people I'm friends with in this industry are doing this. It makes a lot of sense to me. The question I want to ask you is, knowing we have supply chain issues right now, there's tons of manufacturers that can't get parts, can't build. We're getting that in the construction industry too. Where do you feel safe investing? Like, what are your kind of I feel like this will always be there. This company is always going to survive, even in a situation where we might potentially have some supply chain crisis coming?
Yeah. So first of all, I want to talk about maybe a little bit about your Florida real estate. Your Florida real estate, the good thing for you right now is the Canadian dollar has appreciated significantly.
Yeah.
So that is a huge boon to you. You've made actually around 6% already this year. 6%. That's huge. And that's going to give you a lot of space to be able to increase your purchasing power down south. Second thing, if companies that we invest in, well, we invest in the same companies over and over again. Companies that we use day in and day out. Your Apples, your Microsoft, your Facebook. Now, are they going to be impacted by supply chain constraints? Not really, because they're online businesses entirely. So the supply constraint, and that's also, in my opinion, transitory at this point in time.
Okay.
Because eventually the supply chain will sort itself out. Right now, you have a reopening of the economy, massive demand, right? And the supply side of it is still constrained because people haven't got back to work. All the parts are not rolling in. There's a chip shortage. That's going to take some time to sort out. And that's why you're seeing a huge amount of inflationary pressure. But that should subside once things open up more and more. But we focus entirely on high quality companies. We don't change them from time to time.
So you don't care about the situation now versus another time. So you still like your Microsoft, your Apple. So you're into tech a lot then.
Tech. We're also into Starbucks, Nike, Disney. So we're into all kinds of things. We own about 10 to 15 stocks that we think are going to be there long term, regardless of temporary events like inflationary pressure. What are the companies that are going to hold up well over a long period of time? That's the right way to invest. So,
and I like the longevity approach. That as Matt Pichet calls it, the boring. He likes boring, and he likes it. Stuff that's just, it's not going to do anything crazy, but you can kind of bet on it, so to speak. I'm a fan of that too. So just to go back to your point, you mentioned that you believe this is transitory. So right now it's all supply and demand, so it drives prices up. So new construction is really expensive right now in Ontario because there's all kinds of issues with supply, mainly with lumber, which is like triple, quadruple the price of normal. And there are other things too. Everything. Steel's up, aluminum's up, like everything, you name it. I mean, I haven't heard that drywall's up, but I mean, a lot of things are. When that returns to normal, new construction becomes cheaper. Therefore, resale should now take a trim back. So people buying so are you saying that you feel that people are buying in the height of the market right now?
I'm not necessarily saying that. This market is irrational. Who knows where it could go?
It is irrational.
It could go higher. Who can predict? What I'm saying is the numbers simply don't make sense at this point. Our job as investors is to allocate our capital to the most efficient source possible. To me, at these prices, with the rents I'm getting, I'm not willing to throw more money at it because it simply doesn't make sense. It doesn't make financial and economic sense. That's what I'm saying.
Same. I sold a bunch of my student rentals, and that's the money that I've allocated to start building stuff in Florida, because it's still supply issues there, but I mean, I can make that money go a lot further. And like you said, the dollar's helping too. But I mean, I am interested in this too. So this is a well-timed discussion. I am interested in pursuing this avenue. It's just, it felt
you should be. Trust me, this is a game changer. Once you understand it, it will change the way you think about money.
To me, it just felt like a potential distraction. So maybe before we go further into this, could you explain the concept of what it is you do? Your primary, because you're doing covered calls and naked puts, right?
Yeah, that's correct. Naked puts and covered calls. It might sound like, what are those? What does that even mean, right? I'll explain it to you. All right, I'm going to give you a real estate analogy, okay? And the real estate analogy is this. Let's say we walk into Fantasyland, Ontario, a city called Fantasyland, okay? And we see a duplex for $500,000. I know they don't exist anymore, but this is just for example purposes. We see a $500,000 duplex, and the numbers make sense at $500,000. That's what we run our numbers, and we say this is a pretty reasonable deal at $500,000. Okay, and a year from now, we think it'll be worth $520,000, $530,000, maybe even $550,000 because of various issues like rent going up and maybe a little bit of rates going down. But let's just call it $500,000, and we think a year from now it'll be worth $550,000. Okay. Now, I have one choice, really. I can just put an offer on this property and try to get it at $500,000, hopefully, maybe even a little bit less. But if the owner accepts, I'm good to go. So let's say, for example, we told homeowner, "Hey, homeowner, we know your house is worth $500,000, and we believe it's worth $500,000. In fact, we even think it'll be worth $550,000 a year from now. How about I agree to buy your house for $490,000 for 30 days? Okay, I'll take it off your hands for $10,000 below market rent, market value." And the homeowners will say, "Why would I do that?" And you tell the homeowner, "You know what, homeowner? On top of that, you're going to pay me another $10,000 for 1 month. simply for agreeing to buy your house for $10,000 less than its current market value. What is that homeowner going to say to me? Might call the cops, right? Say, get the hell off my property. That would be some typical responses that I would expect to get from that sort of homeowner. You cannot do that in the real estate market, but you can do that in the stock market.
Yeah.
And that is exactly what we do all day long. We simply agree to buy stocks that we wanted to buy anyways. We get paid a lot of money for it. And the worst thing that'll happen to us is, we'll own an Apple or a Facebook or a Nike. We're more than happy to do that.
So so to reiterate, you pick a batch of stocks that you love, stocks you would want to own anyway. And essentially what you're doing is selling an insurance policy.
Correct.
To the marketplace, whoever wants to buy that insurance policy, that you will agree to buy it for less than current value. But anybody who's worried that stock might fluctuate, so you're bullish, you believe it's going to go up, they might believe it's going to go down, and they're willing to take your bet. So you make money. If the stock goes up in price, like you think it will, you just collect the insurance premium.
Yep.
And if it goes down in price, you might have to buy that stock. But what do you feel about that scenario?
Well, again, so I've already done my homework, right? So let's say, for example, an Apple's at 125. A year from now, let's say I think it's worth 150. We've done our homework on Apple. We think it's going to be worth a lot more. So if it happens to, let's say it's at 125 today, I agree to buy it for 120. If it happens to go to 120, I'm not going to be upset. I'm going to be happy because I think the asset is worth far more. And on top of that, I got a discount. I got a $5 discount from the current market value. And someone paid me, let's say 3 or 4% just for agreeing to buy it. So yeah, I'm more than happy. That's a complete win-win for me. So again, going back to that house example. If that house example happened to work out that scenario where you thought that house was worth $550, you told homeowner, hey, I'll buy it for $490, and it happened to go down to $490, and you had to buy it. Would you be happy or would you be upset?
I mean, I'd be happy as long as the cash flow stayed the same, right? I mean, I'm just getting it for cheaper. Yeah.
Yeah. Let's say the cash flow is actually increasing.
Well, it'll get better, right? I'll buy it for cheaper.
Right.
Yeah.
Right.
So that makes perfect sense. And when I heard this strategy, and I actually heard it first from you, and I know a lot of people are doing it now, but it kind of made me think, like, why would anybody buy a stock normally? If you want that stock, just keep selling puts on it until it finally goes down in value. In the whole way you're trying to buy that stock, you're making money.
Yeah. Sometimes like last year during the pandemic, the market presented tremendous opportunities. So instead of agreeing to buy it lower, you were just actually better off buying it lower because it could snap back so quickly in price. So so
you just wanted to buy it at that point.
Absolutely. Because if the stock has gone down by 30%, if I collect 4% or 5% of the premium, well, I'd rather just own the stock because I think it's going to rebound. And they all did. So sometimes you're better off just buying the stock, but the vast majority of the time, I'm more than happy to agree to buy it for a lower price and get paid for it. I'll give you an example. Let's say Facebook. Facebook's at $300 a share. Okay, I go in there and I say, hey, I'm gonna buy Facebook I'm gonna agree to buy Facebook for $280 for 1 month. That's a $20 discount, right? Now I think Facebook will be worth $325 or $330 from a year from now. I agree to buy it for $280, and someone pays me like $8 a share just for agreeing to buy it. I'm all in.
So that someone's motivation is they're worried. They don't see what you see in their head. They're worried that Facebook's going to go down and that they're going to lose money on their investment. So they want to pay you for the right to sleep at night, so to speak. Two reasons why. Good question though. You must be wondering, why would someone do this? I agree with you. One reason is, generally speaking, they hedge. Okay, so let's say, for example, I own a bunch of shares of Facebook, and I gotta sell my shares because the stock market fluctuates a lot more than the real estate market. And I say to myself, you know what? I got to get rid of my Facebook shares for at least $280. Why? Because I need that money for a down payment on a house I'm putting in Florida. Okay. So I essentially buy insurance. We're acting as the de facto insurance company. We're more than happy to take their money because we're happy to own the stock at that price. That's the first type of person. The second type of person is the gambler / speculator. I don't know what they're thinking. They're always looking to turn a small amount of money into a large amount of money. I always try to understand their mindset. I don't to this day because most often they're going to lose their money. But then I think of the casino before pandemic, and you would drive by Niagara or Aurelia or whatever. I'm not in the casinos at all, but I know they're always packed. Why are they packed? People in there know that the odds are so heavily stacked against them, yet they're willingly throwing their money away. Right? The same thing occurs with when we write naked puts on high quality stocks. The odds of them losing their money are extremely high, yet they continue to do it. Why? Because they're speculating. They're looking to turn a small amount of money
into a large amount of money. And we're more than happy to take the money.
It makes a heck of a lot more sense to do what you do and know that it's profitable overall. As long as you do it right. I mean, I'm assuming there's a lot more to it to pick smart and, pick good stocks and such. But it makes a lot more sense to gamble in that way where the odds are in your favor. In my mind,
Correct.
Anyway. That's not advice to anyone.
Yeah, you're not gambling at that point in time. You're an investor, right? You objectively look at a company, you look at an Apple, right? You go through their financial statements, you look at how much money they're earning, and then you apply a multiple to that. And then you say, okay, well, I think this the same way you would evaluate an apartment building. You go in there, you look at the rents, you're like, okay, I can raise the rent on 8 of these 15 units. Okay. Mm-hmm. And you say, okay, here's my cap rate. If I raise the rent to market rent on these 8 units, even if the cap rate remains the same, here's the increase in my price. That's the exercise we go through when we buy a commercial property. Let's say like a multi-res, okay?
Yeah.
The same thing is what you do on the stock side, but people just don't understand it. Real estate people mostly. You go there, you look at Apple's financial statements. So you say, okay, a year from now, based upon the earnings and the growth rate, I expect the stock to be worth $150 a share. Today, it's currently at $125. So when you agree to buy it for slightly below its current market price, you're getting paid these huge premiums. You're more than happy to take that risk on because you've done your homework. Mm-hmm. And that, to me, makes it such a great investment because, it's a win-win for me. I'm happy to take the money. I'm happy to own the stock. I'm happy either way. Yeah.
Yeah. Well, that's the part I like. So, I mean, I definitely can see the value in that. But what do you say to people like me who, for the longest time, I just figured this was going to take too much of my time to learn. And I come from a business background. Like I learned, calls and puts in university. But yeah. I never actually, like you said, never had any practical experience with it. I'd never actually gotten into it. For me, real estate made so much more sense back in the day. The cash flow, the returns just seemed higher to me. But now I don't necessarily feel that way. So now this makes a lot more sense to me to go down this route. But what do you say to people who say, I got a good thing going in real estate? This would be a distraction to me.
I would say that's just closed-minded thinking. That's exactly what I would say. I would say real estate might have done well the last 20 plus years, and everyone thinks they're a genius, right? Mm-hmm. That's the reality of it, okay? Everyone and their cat, as far as I know, the people that I know, everyone has bought real estate, and a lot of people have made a lot of money, including myself. Mm-hmm. And I believe in real estate long-term, but you cannot willfully be ignorant towards valuation. When you objectively look at the valuation of the Southern Ontario market, you say, well, no, I'm just going to keep throwing money at this because I don't want another distraction. Well, I don't consider it a distraction. I consider it another mechanism for me to make money. So in fact, I spend way more time building my real estate portfolio than I do trading. Trading takes me 30 minutes a day. I can do it from anywhere in the world. I don't have to deal with any tenants, any property managers, any assistants, any banks, nothing, just me and my phone. So in fact, if you put in the upfront work, which I think is probably about 50 to 100 hours, subsequent to that, you're only putting in half an hour a day. Can you imagine a point in your life, maybe let's say 5 years from now, you're traveling the world, you're spending 30 minutes a day trading, you can create phenomenal cash flow just from your phone.
Mm-hmm. Yeah, I went golfing with a guy in Florida. He's from Ontario. He came down and he's working his full-time job still. But he's been making 15 to 20% a month. I don't know what he's into. He's probably taking some riskier moves, but 15 to 20% a month.
Oh, he's not. He's that's way riskier than we would. That's I know what he's in. Yeah. That can get very dangerous. Okay, so when you're doing stuff like that, like the reason we stick to our strategy, and it typically makes us like let's say 1 to about 4 or 5% a month. That's still very good money.
That's fantastic. If 5% a month on $100,000 base of capital is pretty solid. Would that be enough? Would $100,000 be enough for someone?
$100. Even $10,000 would be enough. The idea is not the money. The idea is to learn the concepts, get the knowledge down. You can always. The great thing about trading is you can scale the crap out of it. Whether you have $100,000 or 10 million or 100 million, it's the same thing. You can scale it very easily. What I would say is, if you're taking on excess risk, the reason we trade the way we do is because we want to ensure that our worst case scenario is that we own a high quality asset. When you're trading these other strategies like a credit spread or whatnot, you have the potential to lose all your money. And I'm not at all okay with that.
So you stick with the more conservative approach to this. Let's not lose money. Let's not take high risk. Let's just focus on stuff that makes a lot more sense to earn a more steady, predictable return.
Yeah, and also it's not like last year. I think I did 62%. That's a very nice rate of return. And I stick to the Warren Buffett philosophy. The first rule of investing is not to lose our money. Second rule, don't forget rule number 1. If the greatest investor is sticking to these rules, I would be a fool to veer from them, right? So
fair point.
we don't veer from them. And this is why your friend in Florida who's making 15, 20%, I know exactly what he's doing. Did something called credit spreads. And yes, they can be quite lucrative, but they can be devastating on the downside. We don't do that.
Yeah, I mean, with something like that, and I think he explained it to me that he has only a small portion of his capital that's in that type of investment, and then the rest is in stuff that's more steady. So, yeah, I mean, I think that everyone's got to weigh the risk, and it's the same thing I do in real estate. Like, I'm always evaluating the risk I'm taking if I'm buying something. How many outs do I have? You know, my plan A, B, and C. Like, if I'm in credit spreads and I only have a plan A, and if plan B and C happen, I'm really in bad trouble. Then that's not good.
That's not good. Exactly. Yeah.
Okay, so
even like imagine this: if the real estate market were to pull back by 10%, you'd be okay. You'd be able to hang around, right? You collect your rent, you get positive cash flow, you pay your mortgage down. It's not the end of the world. But when you're doing a credit spread, if it goes down 10 or 15%, you're wiped out. Like, it means you're done, and that's not a good place to be. It's way too high risk, in my opinion.
Yeah, and for anyone who's not following that, I'm not even 100% familiar with credit spreads, so don't worry about that. We're just kind of illustrating that there are certain strategies within this that could be riskier or less risky.
What I mean is, sorry, when people hear the word options, they automatically assume risk. Oh my God, that's risky. I've heard that's risky. It's like saying the world of commercial real estate is risky. Well, maybe a strip plaza in the middle of nowhere is risky, but not all commercial real estate. So it really depends on what you do. And we are very specific to our strategy. We don't veer from it.
Okay. Now I do have a question, and for everyone listening, like I'm asking the questions as I had them kind of come up in my head when I learned about this. So what I wanted to know early on was, how does this actually practically happen? Like, where would you offer to sell a put, and who would possibly buy that, and how quickly does that happen? Where, when does somebody snap that up? Just because I want to sell something doesn't mean somebody else immediately wants to buy. How does that process all work?
Yeah, good question. You basically open a brokerage account wherever you want, your RBC, your TD. We use interactive brokers. And then from there, just like you would go and buy a stock, you just say, look, I want to buy 100 shares of Apple, and you buy it. That's it. The same thing exists on the options market. So someone is looking for insurance, someone wants to take out insurance. Now we're constantly selling insurance. So it's a virtual playing field. It might take me, 10 seconds to execute a trade. Very simple. So it's very seamless and very cheap.
So say you wanted to sell a put on Microsoft later today, and you went, you looked at the current price of Microsoft. I don't know exactly where that is, but you priced your offer $20 under. How likely are you to find someone that's willing to take pick up that or buy that insurance policy? We'll call it the put, buy that insurance policy today. How likely is it that would happen today if you made that offer?
Very highly likely. In any given month, there's over $200 billion in premium exchange hands. Think of that number.
200 billion?
Billion with a B. Just in premiums, not the actual value of the stock, just in premiums.
Yeah.
So that is a massive marketplace, right? Annualize that. That's greater than greater than the size of the Canadian economy. That's $2.4 trillion US.
That's crazy.
That's just premiums changing hands on a daily basis.
And this is a market not many people know about, really.
Not many people know about, It's a massive market. People are unaware of it. And the unfortunate part with some people, not all people, some people, I give them a lot of kudos. A lot of people are closed-minded. No, I don't want to learn anything. It's like, I know real estate, and that's all I'm going to ever do. That is, our job as investors is to allocate our capital to the most efficient source possible. If that's not, like and I know, look at your properties, look at my properties. I'm not happy to buy them at this price. I'm just simply not. And I won't, because it doesn't make sense.
Yep. That's where I'm at too. I just won't, I won't pay these prices, and I don't want to go north. I don't want to go north. So I went south, but I mean, I'm also open to this too. This is another potentially lucrative opportunity. And, for the longest time, I was what you described. I don't want to get distracted. I'm very, I'm busy. Do I have that 100 hours to invest in learning this? Is it something I want to pursue? And, it's funny. I just keep seeing more and more people do this. I'm like, what the heck is going on? Everybody's doing this and I'm not. So not that I like to be that way, but I certainly, it does give me a reason to look.
Yeah, no, I think because the first time, we started this in September of 19, and for whatever reason, we've had a lot of real estate investors gravitate towards our program. It's because it resonates well with them. They understand that, hey, wait a second, my worst case scenario is that I own an Apple or a Facebook and I got a discounted price. And also check this out. Let's say, for example, I bought Apple at it's at 125 today. I agreed to buy it for 120. Let's say it goes to 115, right? I had to buy it. Well, it happens. I can turn around and agree to sell my Apple shares for a certain price and get paid again, another premium, right? So that's called a covered call. So there's a lot of ways to make money. And what's the worst that'll happen to me? Well, as long as I'm not borrowing or leveraging myself, I own Apple. I'm okay owning Apple shares. That's the beauty of it. It allows me to sleep all night. I'm done in 30 minutes. I made 62% last year. I make pretty good money on this pretty much every year. This is how I acquired my real estate portfolio. So,
I was going to ask you that. So two questions. One is your balance about the real estate and stocks and how and where you might look to get back into real estate or deploy some of your profits into real estate again. But the other thing is, so you have to buy. So one put is an agreement that you would buy 100 shares, correct?
That's correct. Yes.
Yeah.
So let's say,
you've got to have the money available. If Apple's $100 or 110, then you've got to have 110,000 available in your trading account.
11 grand. Yeah.
So, 11 grand. Sorry. Sometimes when I'm doing that fast math, I get
me too.
So if you get into that, like, so say Amazon at 3,200, now you've got to have a lot of money available.
To do one contract, you'd have to have 320,000 US.
Yeah.
And that's not feasible for most people. But
so people getting started are never going to sell a put on Amazon. They're just not going to be able to.
No, but they can certainly sell a put on Apple, right? Or something cheaper than that. That's not a problem.
Okay, so how are you looking at this? Is there a point that you reach in your trading account of profit, of increasing your basic capital, that you're going to look and say, okay, now I want to deploy some of this back into real estate? What do you look for? How do you know when it's time to put money back into real estate?
When others are greedy, be fearful. And when others are fearful, be greedy.
Yeah.
Right. In the real estate market right now, I see nothing but greed and euphoria. Okay. So when that reverses, I'll feel a lot more comfortable putting money in real estate when the numbers make more sense. Right now, there's nothing but I'm going to wait. Absolutely. Yeah. Like I've made a killing off real estate. I'm not saying I haven't. I've made a lot of money off real estate. But do I feel comfortable throwing more of my assets towards an asset category which I feel is at the upper end of where it should be, right? Mm-hmm. It might go higher because it's irrational at this point in time, but how much higher? How much sense does this make? Like I refinanced 2 properties in December and January, and the loan to value ratio was atrocious, right? So I have so much of my capital tied up there, right? Because they simply won't, your debt coverage ratio has to be 1.2, or you're a villain to the bank. And if you don't meet that, and if you notice, I don't know about you, but none of my tenants are leaving right now because they know that as soon as they leave, that unit's going to be filled up with someone at a higher rent, right?
Yeah, the demand's out there, like absolutely through the roof for rentals right now. So it's like they can't afford it, so they'll apply. But I mean, I've seen it coming through applications on my rentals, like people just trying to stretch themselves to get into your place. And one of my tenants actually invited his brother-in-law to come live with them so that they could help pay for their utilities and rent because they were having trouble with it. I'm like, oh man, this is not what I want.
Does that sound like a good scenario? Does that sound like
it's not? No, that's not what you want.
I bought a cottage up north in August of this year, August of 2020. Okay, just pre-construction, not even built yet. Okay, it's gone up 40% since the time. It hasn't even been built yet. So this is the irrationality, which is scaring me in the real estate market. It's not rational, and the numbers don't make sense. So when these numbers start making sense and there's a lot less greed out there, that's when I'll feel comfortable. Or I'll explore other markets like you're doing, like Florida. I think Florida's a smart move. You've got no state sales tax, and you're getting these transient workers, not transient, but people are transitioning from New York and the northern states down to Florida, even California. People moving from high tax states to low tax states. And what are the 2 things that drive property prices? Well, GDP growth, population growth. Yeah,
Florida they need a place to live, right? Construction is booming in Florida. Prices are booming, but they haven't been booming for that long. It's been about a year of pretty much like an aggressive boom. People like the politics in Florida. It's open. So all those people who want an open state, they're going there. And that's the big thing that makes me like it. It's not that there's that much industry or diversity of industry there. It's that people are flocking there. And when more people come, more industry will come because there's more workers that are able-bodied, that are able to do things. So
and do the numbers make sense?
Right now they do. I mean, they're not as good as I'd like, but they're numbers that, you would see in Ontario probably even 10 years ago. So we're in a much more reasonable ballpark. It's not like I'm getting necessarily 1% rule in the area that I'm looking, but if you go a little bit north, you can. And I think there's a lot of opportunity there. So yeah, that was what I was kind of getting at. Like, are you going to look to other real estate markets? So that was my first instinct, since real estate's kind of my game. But yeah, I'm
especially if the Canadian dollar strengthens further. That's a huge benefit to both of us, right? Like if that dollar keeps strengthening, yeah, of course. Like if you notice, the Canadian dollar has gone from about 75 cents to almost 83 cents this year alone. So that means our purchasing power, if we wanted to buy properties in the States, is significantly higher. Right?
Yeah, it's getting better. It's getting better.
Yeah. So if I were to buy properties, it would not be. I cannot make sense of the numbers in Southern Ontario. Yeah, it doesn't make sense to me.
And to iterate that point, anyone who hasn't done this already, I have a cash flow spreadsheet on my website. You can download it, but looking at your numbers, you've got to have your cash flow, because you never know where values will go, and you need to be ready for that. Well, what if property values go down 20%? Am I going to be okay holding this property until it comes back? And if the answer is no, then I think you should think very critically about whether or not you should be buying it all in that market.
And you know, another thing that's happening, Andrew, I don't know about you, but I know a lot of people that I know, okay, they're just simply buying pre-construction, and they're saying, oh, it's going to go up 200 grand by the time it opens. I'm like, really? Is it? You have a crystal ball. You know this is going to happen. Now, the reason I keep looking like a fool when I say this is because it keeps working, right? Yeah. But at some point in time, it is not going to work, right? You just simply can't buy a house and, oh, it's going to go up 200 grand before I even move into it. At some point in time, that's not going to work. And if you keep doing that, and you've got 2 or 3 or 4 pre-constructions, and that thing happens to pull back, well, you're in deep trouble.
Yeah, that's speculation. That's all.
A lot of speculation, yeah. But if you notice, there's a lot of speculation.
You can win in speculation, and everyone thinks they're geniuses here. And actually, that's the other thing is down in Florida, people know that hard times happen, right? They remember 2008. They know that their properties went to 1/10 the value in some areas, 1/10. So they had stuff selling. Wow. Yes, they had duplexes side by side. So I call them semis. They call them duplexes down there in Cape Coral. They were selling 300 and change, went down to like 35,000. That's how much they dropped. People were just trying to give their properties away. So people down there, they're kind of scared. They see things are going up, and here I am. I'm like, you guys haven't seen Ontario. Like, I see what you're saying. But I think that we all need that humility. We all need to know that nothing is for sure. So the fundamentals need to work.
The fundamentals need to work. And if you buy it at a higher price point, as long as your cash flow is there and your property happens to decline, even if it declines, if your cash flow is there, it doesn't matter. You can wait it out.
Yeah. You can still sleep at night. You can still wait, but you have to be ready for your rents to decline too. So you need a buffer. You need some buffer. The rents probably aren't going to decline as much as the property values, but you will still need a buffer. And I believe, that's the feeling I got. And I've listened to interviews of guys that have been investing since 2008 in Florida. And they've said, rents didn't come down like property values did. Like they were still okay. So,
because people got to live somewhere no matter what happens, right? Even the worst economic conditions, you got to live somewhere. Yeah. And
especially with all those people coming in, they've got to find a place to live. So not to say that there is any perfect solution. There isn't. There's no perfect investment. We'll never know for sure. That's why we just stack the odds in our favor. And I think that's what you're doing with your type of investing, Omar, and what I've always tried to do and also share with other people. So what I wanted to ask you is, what is going to do well? Say we have, so I've heard that there's going to be disruptions to oil in the near future. I know we've heard a fair bit of rumblings about impact on chicken and what's available. Knowing that there's some of those interruptions, if someone were to want to take advantage of a potential opportunity, do you see one? And in what areas?
Yeah, I think the world is going to be a vastly different place 5 to 10 years from now. If you look at the upcoming changes, energy is going to completely transform in the next few years. We're going to go from fossil fuels to renewables. Do you know how big that is? You think you're going to incinerate entire utility companies like electric utilities? They're going to be in deep trouble, right? That's massive, okay? The 7 out of the 10 biggest companies revenue-wise are oil and gas companies. They're going to be severely impacted. You've got that change. You've got the coming change in health and genomics, artificial intelligence, blockchain. The world is going to be a vastly different place in a few years from now. And I believe that we're just at this, the top of the first or maybe the bottom of the first inning in this change. Like, look around. You see more Teslas every day?
Yeah.
Every day you see more electric cars, right?
Absolutely.
5 more years from now, the concept of an internal combustion engine will make zero sense, even financially, economically. So instead of just looking at it and viewing it, No, you can make tons of money off it because you know this is happening. You can see it with your own eyes, right? So I'm participating. I plan on making a lot of money next few years off this coming change.
So would you buy, like, you wouldn't really want to sell puts on oil and gas because you'd be bearish on
definitely
them.
not.
You're bearish on them. So you might sell calls. Now you wouldn't do that because you like the covered calls. You wouldn't want to. So you're just staying away from that. You're focusing on the other areas.
Yeah, I think oil and gas. Like, think about it. You know, I just bought a Tesla, my first electric car.
Yeah,
I'm not alone. So many people are moving that direction, and I've owned these big giant AMGs for years. I love my AMGs. You know, that rumbling V8 engine with like 600 horsepower. It's awesome.
Yeah.
But this new electric car, it's faster. It eats no gas, right? It cost me $7 or $8 to fill up overnight. I have no maintenance costs. It's a no-brainer. Yeah. The world is going to move towards that, right? Imagine, I also have solar in my house. Imagine being able to power your solar into your car. You're completely off the grid. I don't even have to worry about the utility companies anymore. Now, what happens when the whole world transitions to that? That is a massive change. Massive change.
Yeah.
You know what's an interesting thing that's going to happen, Andrew? All the real estate that is owned by these corner gas stations, that is all going to come up and be completely useless the next few years. What's going to happen? There may be tremendous opportunity in those gas stations because they're all corner properties, and they're all going to be obsolete in 5 more years. Yeah, there'll still be people who use gas. I get that part. But slowly, they're going to die out. Yeah, and that could be a lot of, well, they won't need it, hardly any of it, right? Like one day, I think you're going to get to the point where, you know, people's like, oh, you drive a gas car? That's crazy, right? That's going to happen, right? Like, I remember when the internet first came out. I don't know, you were probably too young, but I was in university. I'm like, what is this internet thing? I'm like, it's probably some sort of fad, right? It's completely wrong, right? But I was a kid. And I see the same thing happening right now. The change that we as a world, as a society are about to partake in is going to be revolutionary. And there's going to be trillions and trillions of dollars to be made. I just want my slice of that pie, and I intend on grabbing it.
Yeah, it makes a lot of sense. So as far as just so we can say that we talked real estate today, tell me a little bit about your portfolio and what you hold as far as real estate goes. Yeah,
I'll tell you my real estate story. So 0809 markets collapse, stock market. I knew they were going to recover, so I just said, I'll wait it out. But it made me realize I don't ever want to have my money in one asset category. So I was driving by, I live in Mississauga, Ontario. I was driving by Milton, and I saw pre-construction, and I was like, okay, well, I should get into real estate. I went in there and I bought 2 of them. I bought 2 linked 2,000 square foot linked semis together, just attached to the garage.
Yeah, both sides.
350 grand each. And I was like, I didn't know what I was doing. I was just like, I need to buy some sort of asset that's not, and I bought 2 of those. And that clearly was the wrong way to buy it. Now, they happen to work out really, really well in my favor. They've gone up considerably in value. But then I joined and I started learning how to buy real estate. And I acquired a sizable portfolio. So I acquired a lot of single families. I had I had 37 properties at the most at the height. The vast majority of those were single family. I've sold off a bunch, and I still have about 11 or 12 commercial properties left. I've sold off a lot of my single families, and I've thrown that money in my trading account. Okay. The commercial properties I plan on keeping for a long time. I acquired them a long time ago. Some of them are really nice properties in Hamilton, like multiplexes, right along where the LRT route was supposed to go. So I did the right things. I went to City Hall. I looked at where all the infrastructure projects were coming. I ran my numbers, and I bought right along there. I went to look at zoning. You know how many people are so lazy they won't even do that? And I'm not, some people's lives are busy. I get it. But that one day will make you tremendous amounts of money if you know where all the projects are coming in. And they're more than happy to share that information with you. And you tell them, hey, how's your zoning planning? What is your future outlook for the city? They'll tell you all this stuff, right? And so once you know that, you start acquiring properties where you think infrastructure projects and zoning is going to be changed. So that's exactly what I did. I have that portfolio to this day, and I haven't added to it in a few years, but because to me the numbers are insane.
Right. Yeah. They don't make as much sense now. So yeah, single families, those are actually really nice for appreciation, right? Even more so than multifamilies in a lot of cases. Because it can be irrational, right? Real estate investors, we want to stay rational, so we're not going to buy an eightplex if it doesn't make sense. But a homeowner will. A homeowner will.
Yeah.
So
I'm selling 6 of my properties in Hamilton right now. Six single families, and they're actually sold. They're closing between May and July. Now I bought these from like 120, 130, 150, and they're selling anywhere from like 460 to 550. Wow. Now that's just in what, 10 years? Yeah. You know, that's a tripling of price. You know, now, do I think the price is going to go up considerably from here? Perhaps, but I think that money can be allocated elsewhere, right? For me, if I look at the change that's happening in the world, I'm much more happy to take that money and allocate it to these things that I think are revolutionary and they're changing the way the world works. Mm-hmm. I think I'll make a lot more money off those than I will off my property. Yeah. And I can't even refinance them. You know why? Because if I refinance them, the way that servicer, it doesn't make any sense.
Yeah, it won't work, right? Yeah, you'll dry your cash flow out, and
dry my cash flow out. Yeah, then the bank hates you, and then you got this argument with the bank every day. It's tiring.
So yeah, for those who want to look into it, return on equity, you're going to start to see with your real estate, once the value gets way up there, your return on your equity, with so much equity in that property and small mortgage, your return on equity starts to look really small, which means ultimately you may be able to deploy that cash more efficiently somewhere else if you were to sell the property. So you gotta consider taxation and all that. But definitely something to consider. So one more quick question: as far as taxation goes, do you treat this as active income in a company, or is this capital gains when you're selling these stocks or these puts? I guess it would probably be more active, wouldn't it?
For most people, it's considered a capital gain, but obviously you've got to consult their accountant. For me, because I do it as a business and I do it actively, I have multiple corporate accounts and personal accounts. My personal accounts, unfortunately, it's income, but the corporate accounts, no. You can trade within a corporation. So I trade within my real estate corporations, and I let the cash flow just kind of build up. And as it gets higher and higher and higher, then I can either take it out or I can just invest it in there. Or there are huge tax advantages.
So you're saying inside a corporation, each individual transaction is not necessarily taxed.
Right. It's just a corporate tax rate. So unless you withdraw that,
like you're 12 and a half.
Yeah, 12.5%. Exactly.
From there. Okay.
Correct.
Yeah. So anyone who's getting into this, talk to your accountant. But I was just curious, what's happening for you in that circumstance. So that's great. Omar, where do people learn more about what you do and if they wanted to follow you?
Yeah, so thetatradingco.com. I encourage everyone to take a look at our reviews. If you guys are real estate investors, I cannot tell you how many real estate investors we have. So thetatradingco.com. Take a look at our reviews on Google as well, and you'll see what people have to say. I'm going to convert you over, Andrew, as well. I guarantee that. And once you understand how this works, and you understand, I guarantee you it. This will be a part of your daily investing for the rest of your life once you get this.
Yeah, it's sounding more and more like that. So I've just gotta get fully immersed in it. But I appreciate this. Any other words of wisdom you would share with our listeners and viewers as a parting word?
Yeah, I would say don't make the same mistake I did. Right, I did not believe in real estate prior to the 08-09 crash. There is no perfect investment category. People think there is. There's no investment category that's perfect. You must learn multiple asset categories so that you can be opportunistic and take advantage of it. So that's the one thing I will leave people with. Don't just be, real estate's the best. Everyone, we have a saying in the stock market, everyone looks like a genius in a bull market, right? And when the tide turns, that's when you see who's wearing shorts or not.
Yeah.
The tide will eventually turn in real estate, and you're going to find out who's a genius and who's just a speculator. And it comes quick. So I would encourage people to broaden their horizon, educate themselves. There's a lot of money to be made elsewhere besides just real estate. Yeah.
Absolutely. Yeah, there's a Warren Buffett quote, isn't it? When the tide goes out, you'll see who's been swimming without shorts. Or
100%. That's a Warren Buffett quote. We have a lot of Warren Buffett quotes. We believe it's in this philosophy. Absolutely.
Yeah. Okay. Very cool. Yeah, it was interesting chatting with you about this, and I just think it's so on point for so many real estate investors now who are kind of adding this to their mix, and I think there's a lot of good reason to consider it. So I appreciate you sharing this, and look forward to catching up in the future.
Thanks for having me on. I really appreciate the opportunity to share everything.
Thanks for tuning in to today's episode. Please make sure to share this episode far and wide. Help more people. I really appreciate you tuning in. Thanks. I'll see you on the next one.